George Soros, The New Paradigm for Financial Markets, The Credit Crash of 2008 and What It Means. Dive into the world of financial markets and the cause of the 2008 credit crash with George Soros' insightful book, The New Paradigm for Financial Markets, The Credit Crash of 2008 and What It Means. Soros challenges the dominant market belief of equilibrium and perfect knowledge, proposing a more realistic approach with his theory of reflexivity. He argues that this new paradigm must recognize the role of misinterpretations and misunderstandings in the market. Learn how the 2008 financial crisis evolved from a housing bubble to a global meltdown, and how reflexivity provides an alternative framework to comprehend financial markets' ever-changing landscape.
Rethinking the financial paradigm. The financial crisis stems from a faulty paradigm that assumes markets tend towards equilibrium, promoting biased perceptions. Such perceptions influence prices and underlying fundamentals, leading to market troubles. The theory of reflexivity provides a valid alternative to this paradigm. It acknowledges that misconceptions play a crucial role in history, and the understanding of markets should reflect that impact. The prevailing belief of market equilibrium is false, and a new paradigm focusing on the relationship between thinking and reality is necessary. Market participants must seriously consider this theory to prevent similar crises in the future. The unfolding of the financial crisis. The 2007 financial crisis was not just a housing bubble, but a culmination of factors that began with the dot-com bubble burst in 2000 and the 9/11 terrorist attacks. The U.S. Federal Reserve's response of low interest rates created a housing bubble that led to massive construction and inflated property values. The subprime mortgage market grew along with the hedge funds becoming a market craze, and the crisis now extends beyond housing to include various market segments, particularly those utilizing new synthetic financial instruments. Imperfect understanding of financial markets. Market participants' cognitive function is inherently faulty, creating uncertainty in their attempts to manipulate the financial market. Rational expectation theory fails to adequately address how financial markets operate. Reflexivity, limited to social phenomena, offers a preferable alternative to the current paradigm based on biased interpretations of reality rather than knowledge. The market is not self-correcting and fails to reach equilibrium. A paradigm shift is necessary to address these issues. The Reflexivity Concept. George Soros, a survivor of Nazi occupation and communism in Hungary, immigrated to England in 1947. As a student at the London School of Economics, he developed the reflexivity concept, influenced by philosopher Karl Popper. The concept suggests that market participants operate with imperfect understanding, introducing uncertainty and indeterminacy. While it rebuts common misconceptions, it does not yield firm predictions. The theory offers a basis for understanding financial events involving fallible people. Soros questions the extent to which his financial success is a result of his philosophy, but his concept remains an essential contribution to economics. Soros's concept of radical fallibility. The concept of reflexivity challenges the way philosophers and scientists view the world. George Soros takes this further by introducing the postulate of radical fallibility, which implies that market participants are bound to be wrong due to inherent uncertainties and fertile fallacies that exist. He argues that this concept should replace concepts like general equilibrium and rational expectations. Soros's belief in radical fallibility and fertile fallacies play a pivotal role in his philosophy, highlighting that misconceptions exist and play a role in history. The fallacy of rational expectations. The legendary investor and philanthropist George Soros has shown that the concept of rational expectations in financial markets is illogical. Despite the significance of expectations, markets do not naturally reach equilibrium. Soros's fund management model demonstrates that market participants always act with imperfect knowledge and are vulnerable to unintended consequences, such as incorrectly valued market prices. The conglomerate boom in the 1960s was based on the erroneous belief that companies should be valued based on the growth of their reported earnings per share, irrespective of how they generated those earnings. This led to a stark contrast between expectations and reality when the stock prices dropped. Soros believes that all boom-bust processes are based on misunderstandings or misconceptions. Luckily, these periodic crises have resulted in regulatory reforms in the financial system. The unprecedented financial crisis. The current financial crisis differs from previous crises and has brought the entire system to the brink of collapse. The U.S. housing bubble, fueled by loose lending standards and speculative demand, followed Soros's boom-bust model and grew after the tech bubble burst. The superbubble, more complex than the housing bubble, is the result of extreme dependence on market fundamentalism and sophisticated credit creation. The crisis highlights the need to abandon this paradigm responsible for the present market turmoil. George Soros, a lifetime of financial market experience. George Soros is a billionaire investor with over 55 years of experience in the financial market. Starting his career in London in 1954, he witnessed how governments closely regulated banks and markets in the absence of credit cards. After moving to the US in 1956, he became one of the pioneer generations of hedge fund managers. Over the years, he converted his hedge fund into an endowment fund to manage his foundation's assets. Despite the evolving world of finance, Soros worked through various financial crises like the 1973 oil crisis that gave birth to the eurodollar market and 1980s international banking crises. He also observed how regulators have not been able to calculate the risk of new and sophisticated financial instruments, blaming regulatory authorities for permitting institutions to take on risks they cannot calculate. Soros believes in the postulate of radical fallibility, we are bound to be wrong, which guides his investments heavily. As the current financial crisis is expected to lead to more regulatory changes, Soros' experience remains invaluable in providing guiding principles for investors to navigate the ever-evolving financial landscape. The Looming Economic Crisis. The book predicts that the consequences of the current economic crisis in America will be severe and long-lasting compared to previous financial crises. The president is not expected to take significant action to tackle the housing crisis. The Federal Reserve and the Bush administration are unlikely to do what it takes to avoid a recession, and the vulnerable dollar will also hinder their efforts. As a result, the U.S. will likely hit a recession in 2008, and it remains uncertain whether it would result in a global recession. The consequences of the policies pursued by the Bush administration have also endangered the international financial system and have impaired the U.S.'s political dominance. Despite the crisis, some nations such as China, India, and some oil-producing countries are likely to perform well. India is expected to become energy self-sufficient in a few years, while some Middle Eastern oil-producing nations will become sources of economic strength. Developing countries will fare better than developed ones. Soros predicts financial instability and emerging new world order. Billionaire investor George Soros warns of severe disruptions to the financial system, including a housing market that has yet to find a bottom and a falling dollar. He proposes the new reflexivity paradigm that recognizes the fallibility of financial markets and regulatory authorities, emphasizing the importance of regulating credit creation and controlling excess leverage. Soros also calls for accountability from institutions and governments in avoiding asset bubbles and resolving the credit crisis. To limit the collapse of home prices, policy measures should prioritize avoiding foreclosures, including modifications of loan terms and guarantees for refinancing into affordable mortgages. Soros predicts a period of political and financial instability, hopefully followed by the emergence of a new world order.
Through George Soros' expert analysis, it becomes evident that the existing paradigm of financial markets tends towards self-correction and equilibrium, leading to crises like the credit crash of 2008. Soros' theory of reflexivity offers a more grounded alternative, revealing how misconceptions and misunderstandings drive market behavior. The 2008 financial crisis holds potent lessons about the need for new market frameworks, regulatory control, and government intervention to avert future disasters. Embrace Soros' alternative paradigm to gain a sophisticated and clear comprehension of the contemporary financial world, illuminating a new path towards stability and prosperity.